That's right, folks. I just want to give a shout out to my man Austin. He actually suggested we start doing weekly updates with the real estate market. For those that don't know, I've obviously been in the mortgage business since 2005. And a part of this really is there is a lot of data out there that gets confusing when it comes to real estate. And, our job is to really kind of educate folks on, what these pieces of information mean. So I'm going to hop right in and just start discussing some of the headlines that I saw out there. So I did see a lot of people with shares on my Facebook. I appreciate it. With my new post today, where we were talking about the inventory increase for the first time in years in the market. The second piece being listings sold over market saw a sharp decline. Now, what does that mean for somebody that's buying a house? To make things simple, the last year, which would be 2021, we saw about $4.25 trillion in origination. Normal markets are normally about 1.8 to 2.25. But again, last year was a record-setting year. So in years like that, what happens a lot of times is you'll see listings go for higher prices because obviously there's a lot more people that are in the market. Now, what causes that? We have incredibly cheap money. If you look at the history of the housing market, we'll say, your grandparents and parents very much may have paid 15-20%, to purchase a home versus, once Fannie and Freddie came out in the 80s, and it was subsidized, basically what's called the, government-sponsored entities, interest rates actually became a lot more competitive. The idea in theory was to make housing more affordable for everybody so that you didn't have to put down 20% and pay that 18 to 20%. So fast forward, we see a lot of folks that, get upset when rates go up to what we would call sustainable interest rates. Sustainable market interest rates are probably going to be anywhere from 6.5% to 7.5%. That's kind of the norm if you look at the average over the life of actual mortgage interest rates. There's a lot of good information out there, and we'll go over some of that information as well. But just so everybody understands, again, this data that's coming out is basically stating that we're getting to a healthy supply and demand curve. Healthy supply and demand curve basically means it's tipping more towards a buyer's market. But the good thing is a lot of you folks who own real estate or have gotten into flips, what I suggest obviously is getting them out to market as quickly as possible so you can capitalize on the 23% year-over-year appreciation. That's part one. Part two, and again, for those that don't know, my undergrad was in accounting and marketing. I went to John Carroll for a little bit for my master's in finance, so I'm a big finance nerd guy. But again, I think there's a lot of information that comes out here, and people don't know how to understand what that information actually means. So the recent thing again is Feds have recently raised the benchmark interest rate 75 basis points. Now I do see a lot of incorrect information out there when it comes to if it's tied directly to the 30-year interest rates. So the 10-year bond rate basically, right now I think is sitting at about 2.5. What that basically means is, that with bond rates, they're directly attached to mortgage interest rates. And unfortunately, sometimes what happens is when the bond rates do go up and you do have the Feds pushing the interest rates up, it spikes the volatility, but it does not directly correlate with interest rates going up. For instance, the last few weeks we saw interest rates actually start to cool down even after the announcement's out. So again, sky level view, the bond interest rate does not always impact the 30-year interest rate. So just, for those that don't know, like, it's not saying that tomorrow interest rates are going to go up to 10%. anytime the Feds come out, but it does sometimes spike volatility. But what we've seen is it's actually was priced in this last go around into interest rates already. So that's a good thing because interest rates are likely going to stay where they're at. So Feds increased the benchmark rate 75 basis points. So the other thing is, and what I hear a lot of doom and gloom conversations on, is recession doesn't always equate to 2008. A lot of us, that had gone through 2008, that's kind of like our go-to, in our lifetime. There's nothing wrong with that. But if you study the lifelong, cyclical, industries are always cyclical, meaning they always go up, they always go down. But if you study all the downturns basically being, 2 consecutive quarters of negative GDP, so that, in essence would trigger a what's called a recession. Recessions, happen often in the economy cycle, but that doesn't always mean that you're going to see homes lose value like we saw in 2008. That's the biggest thing, because a lot of people are predicting, okay, well, I'm going to just wait until rates go back down to 3%, or I'm going to just wait till the market takes a hair clip and I can buy a house scratch and dent. While I'm all for getting the best bang for your buck, I will tell you that the data in this market points towards there's not an abundance of debt that's out there. So and then the flip side is a lot of the products that created 2008 no longer exist. So anybody that was in the subprime business like myself, 2005 to 2008, pay option arms do not exist. Arm rates do not exist. So, and there's not arms readjusting, which is, many argue, great movie about that is The Big Short. I definitely suggest you watching that because that actually gives a realistic perspective on what's going on. But there's not 9 million arms readjusting. The movie itself is pretty funny because they kind of take you through some of the craziness that we had, via stated programs and all that good stuff where somebody would just state, hey, this is what I make. In today's market, those are kind of called non-QM, and there's not a lot of, products out there that are offered for non-QM. So, so again, we're seeing unemployment actually remaining steadily low. I believe as of today it was like 3.8%, if I'm not mistaken. And then on top of that, consumer spending is still up. So a lot of times in recessions, really what they look for is, hey, are people being unemployed? As of today, that information does not look as if that's true. Now, a good source for all housing information and what I suggest over, again, there's a lot of media outlets that report on the shock value of things, but I'm a big guy that, tunes into Housing Wire. And again, I have no affiliation with these folks, but I think it's good information if you're trying to understand what's going on in the market. Housing Wire is great. Scotsman is great. And then they have something called the Chrisman Report, which is very focused in on mortgages specifically. So any LOs out there, again, I highly suggest you tuning into those three as well as realtors. Because to be honest with you, like I saw at the beginning of this year, a lot of people became disheveled. A lot of even mortgage companies in general didn't know what to do with market rates going up, but it was inevitable. We were on a 10-year run, if not longer, of rates that were just unsustainable. If you have 3% rates, the problem and what you run into with the the banking side is you cannot show a return on your savings account. So many of you folks that are out there, you're trying to figure out, well, why are they pushing interest rates up so high? That's the main reason outside of protecting assets. And a good friend of mine, Tim Bratz, actually, I was recently at an event with for Mark Evans, and Tim Bratz went up there and he kind of explained inflation in the simplest terms. Inflation is made to protect assets so that if you're buying real estate, specifically over the life of that, property, you're not going to have diminishing or no returns, or even worse, negative returns, because as inflation, gets out of hand, the cost of living goes up, the cost of actually owning that real estate goes up, et cetera, et cetera. So that's why interest rates, in theory, go up when they're trying to combat inflation, because they don't want investors or people that actually own real estate to lose out on that. So great tidbit of information again. Appreciate you, Tim, and that was a great bit of insight. And there's also been some data pointing towards retail, spending numbers being off. If you tune into CNBC, they actually, I think CNBC is a great news source. I believe that, if you're putting out opinion pieces, that isn't actual news. CNBC is kind of straight to the markets, and that's what I appreciate. A lot of them pointed towards retail's number being down, specifically on the lower socioeconomic scale, which I don't believe, there's any, like making it sound like lower, but there's people that obviously spend or actually gross less income that are being severely impacted by inflation. My take on inflation is obviously, there's a perfect storm. You had the pandemic going on. You had, vastly different administrations when it comes to, spending and where money was going. I was looking at like a staggering statistic, and basically it stated, if every household income assumed the debt that we're in currently, each household income would be, like if you're just looking at your checking account, each household would be like $65,000 in the negative. So to put things in perspective, when you just borrow against money that doesn't exist, that in theory causes inflation to skyrocket. And the funny thing is, we haven't seen inflation impact us since the 70s. More or less, a lot of folks are saying, this may be even worse than in the 70s. But again, the feds are doing their best, right or wrong, to try to combat the inflation that we're all seeing. You go to your local grocery store, et cetera, you're seeing a lot of, price increases. You can go and see it on your at your gas pump as well. Gas, per gallon's going up, et cetera. Now, the biggest thing, and we always will stay independent in thought. We don't really go into politics left or right. But the biggest thing I always tell everybody is, if a politician does not have an ironclad plan on how to fix things, then you should not vote for them, period, point blank. And I'm only saying this because we got, midterm elections coming up. And again, I'm independent in thought. We're not here to steer you one way or another. But one thing I will say is, you should hold people to economic plans, because no matter what, all levels are impacted when the economy goes into recession, when inflation, gets out of hand. Every socioeconomic level is impacted by this. I don't care how rich or how poor you are. We're all tied together. And unfortunately, a dirty part of politics is they make it sound as if it's us versus them, and that's just not the reality of things. Again, we're going to start doing these market updates. I would say probably once a week. And the focus on them, again, is to just give you guys snippets on, what's going on in the market, and then, help you make the right decision if you're currently buying or investing in real estate. We may have some special guests on here as well outside of, our normal podcast, Equity Equals Freedom. But we think that in this market, with all the information that's out there, it's probably best, to curtail the media hype, to curtail all the hysteria that's out there, and, give you, I guess, realistic information on what's going on. So again, great time to buy real estate. I would say that, if you're a seller, or if you're a rehabber, or you're a flipper, or whatever, get your properties out there, because you definitely want to capitalize on the return that we're seeing out there of the year over year, 20% appreciation. But the flip side is buyers like you looking for some magical interest rates that really don't exist anymore. You need to stop that. The number one way to create wealth is through real estate. And a focus of Equity CMG is to really help folks understand this. And, the best time to buy, as they say in real estate, is yesterday. So on that note, again, we're going to start pushing these weekly clips out on market updates, and hope you guys tune in. Check us out. We're streaming on all platforms. Equity Equals Freedom podcast, and we look forward to hearing back from you folks. All right, take care.